Today we're going to be discussing the dangers of investing in one of the most popular ETFs here in Canada, VFE, an S&P 500 ETF, and introduce you to a possible better option. Stay tuned in to find out what I'm currently doing in my portfolio. Now let's get into it. Hey everyone, it's Jimmy here. Welcome to the channel. I wanted to discuss what I consider is an important topic in today's climate due to the fluctuations we have been seeing in the United States and Canadian dollar exchange rate in the past couple of months. VFV is talked about all over social media platforms as being the must-hold ETF in a long-term portfolio, and as you can tell on Wealthsimple, it rightfully holds the top spot for most popular ETFs. However, one thing you may not know when you're investing in VFV is that you're not just playing the market, you're also playing the currency exchange game. Let's break it down. VFV is a Canadian-based fund that tracks the S&P 500 index. This means that the fund's performance is tied to the US market. But here's the twist. The fund's value is also influenced by the exchange rate between the US dollar and the Canadian dollar. Picture this, you're a Canadian investor and the US market is booming. Sounds like a win, right? But wait, say if the United States and Canadian dollar exchange rate comes down at the same time, your returns could take a hit. Why do you ask? Well, when you make a conversion from US dollars to Canadian dollars, after there has been a decrease in the exchange rate, you would get less Canadian dollars back. On the other hand, if the United States and Canadian dollar exchange rate goes up at the same time, you could also be in for a double win. Not only are US investments doing well, but you also get more Canadian dollars when you make the conversion from US dollars to Canadian dollars. However, this is all dependent on currency fluctuations, which is a direct result of macroeconomic factors. And as such, it can be unpredictable and volatile. So while you might be lucky one day, you could also just as easily be facing losses the next. This unpredictability related to fluctuations in currency is what we call currency risk. To illustrate this, let's dive into a real life scenario and put some numbers into our explanation. Say you live in Canada and you want to buy some Fairlife protein shakes, but as always, they are sold out here at Costco. So you decide to purchase them online from a United States vendor. Say the protein shakes cost 30 USD, and at the time of purchase, the exchange rate was 1 USD for 1.30 CAD. So you exchange 39 CAD for 30 USD and purchase the protein shakes. Now let's say a few days later, the exchange rate significantly changes, which can happen especially in volatile times. And the new rate is 1 USD for 1.25 CAD. And now, if you decide to return the protein shakes back to the US vendor, you'd only receive 37.50 CAD in return. As you can see, although it looks minimal, you lost some value in Canadian dollars because the United States and Canadian dollar exchange rate has decreased. Now let's quickly look at an extreme example. Say you want to buy 10 pallets of these amazing protein shakes. The total cost is 10,000 USD, so you exchange 13,000 CAD for 10,000 USD to purchase the protein shakes. But then, you decided to return the 10 pallets a couple days later because that's way too many shakes, and the exchange rate fell to 1 USD to 1.25 CAD. And now, you'll only receive $12,500 back in Canadian dollars. As you just saw, you might look at currency risk as insignificant if you're playing with small amounts, but hopefully, as you build your investment portfolios, you will see that when you have a higher amount of play, the more drastic the changes of currency has to your money. So what's the solution? Well, there's no foolproof way to predict or control currency fluctuations, but there is an ETF which many investors may not know about, which will help mitigate currency risk. If you didn't know, Vanguard has another S&P 500 ETF, which is VSP. Now you might be wondering what are the differences between VFE and VSP. Well, the major difference is VFE is not hedged with the Canadian dollar, whereas VSP is hedged with the Canadian dollar. This currency hedging is designed to mitigate the impact of fluctuations in the exchange rate between the US and Canadian dollar. Although both ETFs mirror the S&P 500 index, VSP will act more similarly compared to the S&P 500 index, plus or minus some small increments due to costs associated with the hedging and the management expense of the ETF. Now we're going to be looking at a most recent example to illustrate the difference between these two ETFs. If we look at the recent lows of the S&P 500 index made at the end of October 2023 and the bounce back it had, we can see the index has increased by 16.13%. If we look at VFE, the most popular S&P 500 ETF here in Canada, you can see it only has increased by 10.91%. And now if you look at VSP, you can see that this ETF has increased by 15.82%. So in the same time span, although both ETFs track the S&P 500 index, the difference between VFE and VSP is around 5%. Now you might be wondering why there is such a big difference. Well, it's because VFE, as we have been discussing, is tied with the US and Canadian dollar exchange rate. And during this time, we can see that the exchange rate has decreased by 4.88%. As such, the difference in percentage of VFE and VSP is directly related to the change in the United States and Canadian dollar exchange rate. Although we just looked at a small time frame, you can see that currency risk is something to consider for your investments, and might influence you whether or not you hold an unhedged or hedged ETF. Now let's look at a bigger time frame. Here we have a 5-year chart from Seeking Alpha showing the total returns of both the ETFs and the index. The total returns show that VFE has actually outperformed the index by around 6%. However, as you can see in the chart, VFE, in the color orange, has shown to be more volatile than VSB and underperformed the index in 2019 and especially in 2021, where VSB has relatively shown similar returns with the index in the 5-year time span. So now what? If you look at this chart of the US and Canadian dollar exchange rate, you can see that when we are at or near the top of its range, you will need to consider if it's your best bet to stay unprotected against currency fluctuations or purchase VSP, which is hedged to Canadian dollar. If we are at the top range and if you believe the United States Canadian dollar exchange rate will weaken over time, VSP will be a better option. However, say if you believe the United States Canadian dollar exchange rate will strengthen over time, then purchasing VFV would be your best bet. Being said, I believe there's always a time and place for deciding which strategy you want to choose. For example, being unhedged has not always been a bad thing. Say if you purchased VFV in 2021, when the USD and Canadian dollar exchange rate was relatively low. Then you helped your total returns as you not only benefited from the increase in the S&P 500 index, but also in the increase of the United States and Canadian dollar exchange rate. When choosing between these two ETFs, I've highlighted a few considerations to keep in mind. As we have been discussing, the first one is currency risk. The primary difference between VFV and VSP is the currency hedging. If the exchange rate moves against you, you might end up with less return than you initially thought. Therefore, hedging can mitigate the potential financial loss in currency fluctuations. If you want to avoid currency risk altogether and have your returns identical or relatively somewhat identical to the S&P 500 index, then purchasing VSP would be the better choice. The second one is the costs related to VFV and VSP. Comparing the management expense ratio, which is the MER, which means the total cost of holding the fund, we can see both ETFs have an MER of 0.09%. So you don't have to worry about any additional costs when deciding between holding an unhedged or hedged ETF. My real life example experiencing currency risk is when I bought VFV in 2020 when the stock market crashed. And at this time, the United States and Canadian dollar exchange rate was high. I didn't notice it much in 2020 since my position in VFV was small. But in 2021, as my position increased, I saw my total returns from VFV not increase as much as the S&P 500 index was increasing. This was because, as you can see, the United States and Canadian dollar exchange rate was steadily decreasing since its highs in 2020. This is when I first discovered the risk related to currency fluctuations. Now at this time, I see the United States and Canadian dollar exchange rate in the upper half of its range compared to the previous 5 years. Therefore, I do not want to risk my total returns taking a hit if there's a continuous drop in the exchange rate. Although I have positions in both VFV and VSP, in this environment, I am focused on strictly purchasing VSP. When deciding between these two ETFs, you need to think about your risk tolerance, investment goals, and time horizon. Each of these alternatives offer a different balance of risk and reward, so it's all about finding what works best for you. Remember, there's more than one way to build a profitable portfolio. As well, although I only discuss and compare ETFs for the S&P 500 index, there are also alternative ETFs for other indices such as the Vanguard's Dividend Appreciation Fund, VGG and VGH, and Vanguard's US Total Market Fund, VUN and VUS. Also, it's not only Vanguard who provides these type of products. There are also different ETF providers like iShares and BMO who have a wide range of unhedged and hedged ETFs. Remember, there's no one-size-fits-all answer in the world of investing. Both hedged or unhedged ETFs can play a valuable role in your portfolio depending on your strategy. The most important thing is to stay informed and make choices that align with your financial objectives. If you found this video helpful, please give it a thumbs up and subscribe for more content on investing, finance, and all things money related. And don't forget to share your thoughts in the comment section below. I would love hearing from you. Thanks for joining me today for this breakdown. Until next time, stay locked in.